Hello traders, welcome to your first module and lesson in OTC's Blueprint program, your in-depth guide to professional trading. What I want to focus on in the beginning is to get everyone on the same page when it comes to the financial market. So whether this is your first time learning about trading or you've been trading for some time, we have to start at the beginning anyway. We have one question in mind that I will answer in pretty much every lesson in this program: how to earn consistently from trading. And you might be surprised how straightforward this process is. Not easy, certainly. A lot of work needs to be done here. And that's why we are here, to guide you step by step in this money-making journey. Let's dive into the first point on our agenda: institutions versus retail traders. Who are the key players and what do these markets consist of? The financial market is built around three main asset classes: futures, forex, and stocks. Forex, the largest by daily volume, sees 5.3 trillion traded each day. Futures follow with about $2.6 trillion, while the stock market or the equities market handles around $20 billion daily. Now, this tells us a lot about the dimensions and the size of the financial market. So the question that's still left unanswered is, who are the participants? There are two main groups: retail traders like you, me, and any individual looking to make a profit. And then there's the institutional traders, like for example JP Morgan Chase, who have 2.3 trillion US dollars in financial assets, or Bank of America, who have 2.28 trillion US dollars in financial assets, or Morgan Stanley, who have 851 billion US dollars in financial assets. All of these players are called institutions. These institutions hold trillions in financial assets. To put it into perspective, the top 15 banks alone control $13.2 trillion in trading assets. That's enough to buy every person on the planet a 13-inch MacBook Pro with accessories. That number is unimaginable. And on the other side, you have us, the retail traders, that are maybe trading with a couple of $1,000s in their trading accounts. Now, if you look at any market around the world, like the gold market, crude oil, silver, natural gas, soybeans, the S&P 500, or Apple or Amazon, and you ask yourself why these markets are going up or down, you will understand, and it becomes very crystal clear, that the only reason why any market is going up or down is because one or more than one of the institutional participants are buying or selling in those markets. Trading, much like poker, is a zero-sum game. The chips, aka money, don't increase or decrease, they simply circulate. In both cases, the inexperienced lose their chips to the pros. In the market, money flows from less educated retail traders into the pockets of seasoned institutional investors, who often have vast resources. It's a statistical reality. Many brokers like Rwanda disclose that about 80% of retail traders lose all their money within the first few months of trading. Understanding the game is crucial if you want to avoid being one of them. Before diving in any deeper, let's take a moment to talk about the key elements of a trade. Some of you might have already bought stocks like Apple or ETFs or gold or Bitcoin or other financial instruments. And that's great. But when we participate in any market, we need a clear plan. Every trade consists of three core components: an entry, a stop, and a target. First, the entry is when you open a position at any predefined price. The emphasis here is on predefined, because anyone can jump into the market at any price. But we need a specific, planned entry to control risk. The stop is where you close the position if it moves against you, and the target is where you take profits. Both should also be predefined. This allows you to calculate in advance the potential risk and reward for each trade. To set these levels, you are essentially engaging in market timing and anticipating where prices will turn. The final part is what I call the set and forget and get a live strategy. This is placing the trade in advance and letting it play out in accordance to our predefined set parameters. Once your trade is set, you step back and let it play out. This forget element is crucial for managing emotions and mastering the psychological side of trading, which can often be the most challenging part. Let's start with the first key element of any trade, the entry. As mentioned before, this is the moment you open a new position in the market at a predetermined price. A well-executed, pre-planned entry offers several benefits. One major advantage is improving your risk to reward ratio, which ties into timing the market effectively and understanding concepts like unfilled orders and supply and demand. We will explore these topics further in the program. The second key element of any trade is the stop. As we discussed, the stop is the closing of an open position at a predefined loss. And rule number one is that placing a stop is non-negotiable. Every trade we make will have a stop, and here's why. A predefined stop helps us manage risk with precision, which in turn helps keep our emotions in check. By knowing the maximum loss in advance, we reduce fear and make rational decisions. Ideally, the potential reward should always outweigh the risk. In trading, fear and greed are the two biggest emotional hurdles. Fear comes with the risk of loss, and greed with the lure of gains, both of which can cloud judgment. Predefined parameters like stops and targets remove emotional guessing from the process. Now, here's a very important question. Is getting stopped out a bad thing? The answer is no. It's simply the cost of doing business. You should know that the perception of losing money and how we are going to deal with that perception is going to be extremely important, especially once you're scaling up your business and risking a lot of money. I don't like the words losing and winning because at the end of the day, we are not playing a board game. We want to be in the business of running a professional startup. And trading is going to be your startup business. Like any business, in the world of trading, you need a specific amount of initial capital to invest. In this case, it's the education part that you've invested money in to ensure sustainable and long-term success. Trading is not that different from any other startup business. Let's say you open up a coffee shop down the street. On top of your initial investment, you will have monthly running costs such as coffee beans, waiters, baristas, maintenance costs, rent, maybe you want a delivery service, and many, many more. In trading, while you don't have these classic running costs, you still have the costs of losing trades. And on the other hand, the revenues of winning trades. As long as at the end of the month, or at the end of the quarter, or at the end of the year, you have more revenues than costs, then you're running a profitable business. Now, let's talk about the final element of a trade, the target, which is the closing of an open position at a predefined profit. Setting a target is just as essential as placing a stop, and here's why. It helps control emotions, especially greed. Without a target, you might hold a winning position too long, risking a reversal that could turn a profit into a loss. By setting a target, you already know what your profit or reward will be. This allows you to compare the risk you are willing to take with the reward you are prepared to gain. That is what we call risk to reward ratio. We will spend an entire lesson about this as it is the most important KPI in trading or key performance indicator. There's also the possibility of having several targets as a mean of trade management. In other words, minimizing your risk and taking several profits on prices going in your favor. Long position versus short position. This is an exciting topic because it's right at the heart of our question, how to make money in the financial market. We can make money with buying, taking long positions, and selling, taking short positions. This is where we need to spend a little bit more time because shorting can be confusing in the beginning. But we will make it really simple. Also, we will look at the candlestick charts we use for our supply and demand analysis. But first, what is a long position? The expression "you are going long" means you predict the price will go up. That's why a long position is defined as a position that is bought with the intent to be sold later at a higher price. Let us look at this chart. It is only important to understand the set and how a long position plays out contextually. Based on this chart formation, our analysis would indicate to buy this asset. Let's say we buy this stock at $20 per share. However, current price is trading at $27 per share. So we cannot buy now. And we have to wait for price to come back to $20 for us to be allowed to buy or go long. Remember, we are professional traders. We are not chasing price. We wait for price to come to us. Now, we'll have to place our entry. That's the first element of our trade. What are the other elements that are missing? Right, our stop and target. We can now also place them. According to this chart, let's assume we place our stop loss at $18 per share and our target at $26 per share. Now, our market order is placed, and I want you to see that we predefined our entry. Set, stop, entry, target. And everything will be triggered automatically when price will come down to our predefined entry. Our order is not yet filled. So in other words, it's unfilled, meaning it is a pending execution. Bottom line, we can now walk away from the screen because we placed our set, and we can forget about this position and get alive because all our set parameters are placed in the market and everything will be triggered automatically. As you can see, price is crashing down to our predefined entry. Now our entry was triggered at $20 per share. This means that the order we placed goes from unfilled to filled. Now we are filled in the market. We bought this stock. In other words, we are long. Okay, so the price is going to do whatever it does now. If prices goes sideways, nothing happens. We neither win nor lose money. If price goes up above 20, we make money. And if price goes below 20, we lose money. That's our risk. And since we don't want all our money to be at risk, we protected our position by placing a stop. If price goes lower, we get stopped out with a predefined loss, kind of like insurance. On the other hand, if price goes higher, we close this trade with a predefined profit. Now, price is traveling from our entry, $20 per share, to our predefined target, $26 per share. The trade is closed and we walk away with $6 of profit per share. And the best part, I didn't have to be glued to the screen to click close trade. Any trade could close at the middle of the night or at any time of the day when I'm not looking. Now the set and forget approach is starting to make sense. What is a short position? When someone says you are going short, it means you expect price of an asset to fall. A short position is simply when you sell something with the intention of buying it back later at a lower price. Technically, shorting is not the correct term that we should use for all trading assets. Let me explain. In the stock market, shorting involves borrowing shares, usually from a broker, to sell with the goal of repurchasing them at a lower price. However, in the futures market, you're trading contracts, not shares. So there's no borrowing involved. You just sell a contract directly. Likewise, in the forex market, you're trading currency pairs. So selling one currency automatically involves buying another. For instance, selling euro dollar means selling euros to buy US dollar. The term sell to enter is more accurate in both futures and forex markets. Still, the term shorting has become common when talking about betting on falling prices across all markets. To keep things simple, we'll use it throughout the program, even though it's not always 100% correct. Now, you may wonder, how can you sell something you don't own? The answer is straightforward, and I'll explain it with a simple example. The concept of shorting works like this. If you decide to short a stock, you're planning to sell something you do not own. The broker will allow you to borrow this stock at the specific price and return it back later, either at a loss if prices go up or at a profit if prices go down. Imagine the following circumstance. Alex borrows Frank's iPhone 16 for a month. Alex is a smart businessman. Alex sells Frank's iPhone 16 to Mike, who desperately wants an iPhone 16 right away for $1,500 US. But now, after a month, we have a problem, right? What's the problem? Since the phone was just borrowed, Frank wants his phone back. As we said, Alex is a smart businessman. He knew that during this month, the brand new iPhone 17 is coming into market. So what happens with the old model when a new version is getting released? Exactly, it depreciates in price quite a lot. So he can get it at a discount. So Alex is going to Tom, who knows has the iPhone 16 as well, but wants to upgrade to the new iPhone 17. Tom wants to get rid of the older model. He buys the iPhone 16 from Tom for $1,000. Good deal, right? Now Alex goes back to Frank, who wants his phone back, and Alex returns Frank's iPhone 16, but is leaving with $500 in his pocket. And that's exactly how shorting works. It's very simple and a fabulous way to make money in the market. Think about the emotion that leads the average Joe trader to participate in the market. Fear and greed. Which do you think is the stronger emotion? Well, the fear of losing money is instant, while greed takes more time to build up. That is why when prices fall, for example during times of recessions, they fall 3 times faster as opposed to rising prices. Look at the last stock market crashes, the housing bubble of 2007. While price took 5 years to get from A to B, it only took price 1.5 years to go back from B to A, and even lower. It was even worse during the COVID crash of 2020. Let me try to explain shorting with this chart. Based on this chart formation, our analysis for the specific stock would indicate to short this stock at $50 per share. However, current price is trading at $47 US per share, meaning we cannot short now. We merely pre-planning our set and waiting for prices to come back to $50 per share. Again, remember, we are professional traders. We are not going to chase price. We are waiting for price to come to us. Now, we just have to place our stop and target. Let's say, according to this chart, we place our stop at $52 per share and our target at $46 per share. Only if price travels into our short entry, our predefined entry will be triggered. In the meantime, while price is still trading at $47 per share, our order is not yet filled. In other words, it's unfilled. What are you going to do next? Guess what? Your work is done. You can walk away from your screen, set and forget, and get alive. All the elements, the trade parameters, the entry, the stop, the target are placed and will be triggered automatically. As you can see, price is rallying up to our predefined entry. Now our entry was triggered at $50 per share. This means that the order we placed goes from unfilled to filled. Now we are filled in the market. We sold this stock. In other words, we are short. Okay, so price is going to do whatever it does now. If price goes sideways, nothing happens. We don't win nor lose money. If price goes down, we make money, and if price goes up, we lose money. That's our risk. And since we don't want all our money to be at risk, we protected our position by placing a stop above the entry. If price goes higher, we get stopped out with a predefined loss, kind of like insurance again. On the other hand, if price goes lower, we close this trade with a predefined profit. Exactly what we talked about when going long, but this is in the opposite direction. Now, price is traveling from our entry. It goes all the way down from $50 per share to our predefined target, $46 per share. The trade is now closed and we walk away with $4 of profit per share. To sum it up, we can make money regardless of economic trends and market conditions. Markets are dynamic and they move in cycles, up, down, sideways. We have just shown you a repertoire of tools to make money with 2 of the 3 cycles. In fact, we can make money in all of the 3 directions. But for now, let's stick to our long positions, making money if prices go up, and our short positions, making money with falling prices. On this slide, we have 2 examples side by side. The long position on the left and the short position on the right. Let's start with the long position. The entry is at $20, the stop loss is $18, and the target at $30. The red area represents the risk, $2, and the green area shows the reward, $10. Visually, you can already see that the reward is much larger than the risk, which is ideal. If we divide the reward by the risk, 10 divided by 2, we get a 5-to-1 risk to reward ratio. An excellent ratio, meaning for every $1 you risk, you can potentially earn $5 in profit. Your risk size is flexible. Whether you risk $50 or $500,000, the market can absorb it. If you risk $50, your potential reward would be 5 times that, $250. The same logic applies to the short position. Here, the entry is at $30, the stop loss at $32, and the target at $20. The risk to reward ratio is still 5-to-1, as 10 divided by 2 gives the same result. Understanding this key performance indicator, or KPI for short, is crucial for sustainable trading success. We know there will be losing trades, which are like the operating costs of a business. To be profitable, revenues, which are your rewards, must exceed costs, your losses. This is why we aim for a higher reward than risk. For example, I wouldn't risk $1,000 if the reward is only $1,000, because that's a 1-to-1 ratio. Essentially gambling, but risking $1,000 for potential $5,000 reward, absolutely. Because even if I lose 3 times in a row, 1 win keeps me in the profit. That's it for today's lesson. I know it was pretty packed, but it's the cost of greatness. Next lesson, we will explain everything you need to know about the charts. You don't want to miss that one.